Hello, everyone. Thank you very much for joining this really exciting webinar. I am excited to introduce Doug Carey, CFA and president of WealthTrace. He'll go into a little bit more of his background, WealthTrace, and a little bit about PortfolioPilot. But the more we get into improving financial advice for everybody, the more it felt like, it made sense to set up some sort of partnership between WealthTrace and PortfolioPilot. We're starting off with a webinar series and then actually working on some technical integrations to bring more scenario planning and better long-term financial advice to every self-directed investor, hopefully across America. I will hand it over to Doug. If you have any questions that come up throughout the webinar, please post it in the Q&A chat at the bottom of your screen. And we plan to make the presentation itself about 15 to 20 minutes, and then we'll leave room for a number of questions at the end. So please don't be shy. And after the session, we'll send out a recording to everybody that attended and everyone who wasn't able to attend. It's awesome to see so many people joining today. Doug, enjoy. Over to you.
Thanks, Alexander. And thanks, everyone, for joining today. As Alexander said, my name is Doug Carey. I am a chartered financial analyst, and I'm the CEO and founder of WealthTrace. This presentation is part of a series in conjunction with PortfolioPilot, which is an AI-powered financial advisor for self-directed investors. So today, we're going to talk about how you can save more for retirement, potentially a lot more. And the way you can do this is rolling over your 401k to an IRA. Quick disclosure stuff. This presentation is for educational purposes only. We know investment decisions involve risk, and you should not interpret any statements I make here today as a recommendation or investment strategy. So as I mentioned, I'm a chartered financial analyst. I used to work for FactSet, where I was director of fixed income engineering products. I'm the CEO of WealthTrace. A little more about WealthTrace and what it does. So WealthTrace empowers individuals to build their own comprehensive financial plan. It has advisor level accuracy and details. You can link your investment accounts and you can view your updated holdings every day. You can run Monte Carlo simulations that tells you the probability you will never run out of money. You can run powerful scenarios such as Roth conversions, what happens if you change your asset allocation, or what would happen to your portfolio if there's another recession. You can also get expert one-on-one help with a chartered financial analyst, which is me. And as I mentioned before, this is in partnership with PortfolioPilot.com, your personal AI financial advisor. And some have asked me, why did I build WealthTrace? I just want to quickly say, really, the reason I did it was I was trying to help people reduce their financial anxiety after the recession of 2008, 2010. And, that's a really, really rewarding thing for me. I just really want to help people not be so anxious about their money. So who's this presentation for exactly? Well, if you have a 401k plan and you want to save some money, this is worth listening to. What about the choices in your 401k plan? A lot of people really do complain about the lack of choices. This is not rare. An IRA generally has a lot more choices in terms of funds and ETFs. So that is another reason you might want to roll it over. It's funny, I was thinking the other day about Amazon Prime Day, which was, a week or two ago, and my family's all excited to save 20 bucks, 50 bucks. A lot of people are excited. Amazon Prime Day is great. I love it too. But I think about the savings, the potential savings from things like rolling a 401k over to an IRA and saving on fees versus the savings from something like Prime Day. And it's funny because the potential savings from changing your fees in your plan are so much bigger, hundreds, possibly thousands of times bigger. So put Amazon Prime Day to shame. So today, what we're going to go through is, why would you roll over a 401k to an IRA account? Well, I've talked about fees already. You can have lower fees. Fund choices, I mentioned. There are a lot more fund choices in an IRA compared to a typical 401k plan. Compound interest. I'm going to explain how it works and why it's so important, but basically your fees will compound over time and it can turn a few $1,000s into potentially tens of thousands of dollars. Now, I did want to mention that I don't gain anything when people roll over an IRA, 401k to an IRA. WealthTrace doesn't sell any products. We don't receive any commissions for selling any products. Honestly, I like helping people save money on their investments. As I like to tell a lot of my customers, one of my main goals, and one of the reasons I started my company, is to help people sleep better at night, to help them reduce their financial anxiety. I failed to mention at the end of this webinar as well, we're going to have a Q&A session, so feel free to put questions up in the Q&A section. All right, let's start with the basics. What's an IRA? IRA stands for Individual Retirement Account. It's a personal retirement account you open yourself, not through your employer. You would set this up directly with a bank, broker, or financial institution. The contribution limits this year, $7,500. There is a catch-up contribution of a little over $1,000 more if you're 50 or older. Now, today we're mostly talking about really traditional IRAs. The contributions are tax deductible today. Your withdrawals will be taxed as income later. That's different than a Roth IRA, which is a subject of a different webinar, where the contributions are not tax deductible, but your withdrawals later on are tax-free. Real quickly, the differences from a 401k account, other differences. As I mentioned, you set it up, whereas your 401k plan, your employer sets that up. The contribution limits are different. The 401k has a much higher contribution limit. No employer match for an IRA. I already mentioned investment choices. An IRA can have income limits in terms of how much you're allowed to contribute. That would be tax deductible. A 401k does not have that. When it's taxed, I mentioned that a traditional is taxed when we withdraw. A Roth IRA would be taxed immediately, but when you withdraw it, it's tax-free. You control the IRA. Your employer controls the 401k plan. All right, so as I see it, there are really three big problems here. Problem number one is the fees that a lot of people pay in a 401k plan on their funds. Americans lose thousands of dollars to high 401k fund fees over time. But here's the thing. So many people have no idea. They have no idea what their fees are. And even if they knew their fees, they have no idea or little idea how much it's really costing them over time. 401k plans can have much higher fees than the options in an IRA. And as I said, those small fee differences, and they can be big too, can compound into giant losses. And as I already said also, the IRAs generally have more options in a 401k plan, more fund choices. More on the fund fees. So where do you find your fund fees? There's something called an expense ratio. Most mutual funds and exchange traded funds have an annual fee called an expense ratio. So let's say you're invested $100,000 in a fund and expense ratio is 1%. Well, that means in 1 year, you will pay $1,000 in fees on that fund. Fees on funds can vary wildly. Some older mutual funds can have an expense ratio well over 1%, while many ETFs today are below 0.1%. The most expensive funds tend to be actively managed, whereas index funds have much lower cost and are not really traded very often at all. Now, these are real-world examples of high-fee funds and low-fee funds. I stripped out the names of the actual funds, but these are real. The ones on the left are from an actual 401k plan. The funds on the right are from my own broker. I have an IRA that I can invest in these funds if I wanted to. So you can see, for example, look at the Developing Markets Fund. Look at the New World Fund. These fees are above 1% a year. These are really high. A bond fund with fees of 0.85%, that's pretty high for a bond fund. On the right, you can see total stock market ETF, 0.03%. It's nearing zero. S&P 500 ETF, 0.03%. International funds used to have the highest fees, but now you can get in and get exposure to countries all over the world, 0.06%. So these are stark differences. Our problem number two, I've said it already, Fund fees, IRAs have a lot more fund choices. You can invest in multiple countries, different sectors. A lot of time 401ks do not have this. In fact, I had a 401k in a company long ago, and I remember I could not get exposure to any international countries, not even Europe. And they only had one bond fund to choose from, and I remember it was very high fee. And so if anyone wanted exposure to a bond fund, they had to invest in that high fee fund. The third problem, and this isn't really talked about very often, but it is a problem, and this is conflict of interest. In a lot of these plans, the provider fills the menu with their own funds, which generates profit for them. The expense ratio, the fees of these funds, can be much higher than many others, and guess what? They go to the provider. There are going to be revenue sharing agreements. Some mutual funds pay a portion of their internal fees back to the 401k provider as a kickback for including them in the plan. Believe it or not, this is all legal. This is often called pay to play, and the fund companies compete to get on the plan menu by agreeing to share revenue. Also, a lot of 401k providers offer managed account services or advice for an extra fee. These services a lot of times use only their proprietary funds, even if better or cheaper options exist. So you can see these can be some serious conflicts of interest. Not every 401k plan has these, by the way, but some do. So when can you roll over your 401k to an IRA? Well, you can't do it right away normally, right? You have to wait till you retire usually, or you take another job or are laid off. Sometimes you can do it if the plan is terminated or changed, like if your employer decides to terminate or switch to a different plan provider, you might be given the option to move your money, and then you can roll it over to an IRA. Also, after a divorce, if you're awarded part of an ex-spouse's 401k through a divorce settlement, you can then roll that over to an IRA. Okay, this is important. How to roll over a 401k. So a lot of people might think, you're telling me I can save thousands of dollars. This has got to be difficult, but it's not. I've done it myself. I rolled over a 401k plan to my IRA. It took maybe an hour of my time. It was not hard, and it's easier today. You simply open an IRA account at a broker, you contact your 401k provider, request a direct rollover, and I will get more into that in a bit. They handle rollovers all the time. This is nothing for them. It's super simple for them. They'll tell you exactly what you need to do. The money will move directly to your IRA, and then you invest the funds once it's settled in the funds that you have chosen. Now, there are times where it doesn't make sense to roll over. Let's say you're between 55, 59 and a half. You leave your job when you turn 55, and you can take withdrawals from your 401k at that point. So early. Normally you have to wait till 59 and a half. But if you rolled that money to an IRA, you cannot do that. You have to wait to 59 and a half at that point. So if you needed the money right away, you probably don't want to roll it over. I've also seen, it's kind of rare, where a 401k plan can have very low cost funds, even lower than what you can get in your IRA. It doesn't happen often, but if it does, you might want to stick with them. Oh, also, what if you want to do a backdoor Roth IRA conversion? Again, this is a subject for another webinar, but I will briefly touch on it. A backdoor Roth IRA conversion is when you put money into your 401k plan after tax. So this is after you've already maxed it out in terms of tax deductibility, and you put more money in that's after tax. You can now move this to a Roth immediately if your 401k plans allow it. That's a big if they do. But the problem is if you have an IRA, when you do a backdoor Roth, the IRS will force you to also convert part of that. Now you have a big tax problem. So a backdoor Roth really works best when you have little to no money in an IRA. All right, how to roll over. I already mentioned a direct rollover. If this is what you want to do, don't mess with an indirect rollover. It's only asking for trouble. The direct rollover is where you instruct your 401k plan administrator to send the money directly to your new IRA provider, okay? Directly to them. An indirect rollover is when the check is made out to you personally. Now, they would be legally required to withhold 20% for federal taxes. You have 60 days to deposit that check into the IRA. If you procrastinate or lose a check, forget, whatever, guess what? this is treated as a taxable distribution. You're going to be paying income taxes and penalties on the full amount. So that'd be a nightmare scenario, so don't mess with it. You want a direct rollover. All right, I have a case study that I want to go through, and I used WealthTrace to run some numbers for me. This case study was perfect because I actually talked to a customer a few weeks ago who was in this exact spot, was really thinking about sticking with his 401k plan, wondered why he should roll over to an IRA, and let's just say we had a really good conversation about it. So for this particular case, we have a client who's 60 years old, just retired, single, life expectancy of 90, spends $95,000 a year, has $2.7 million in investments with $2 million in a 401k. He has Social Security benefits of $40,000 a year when he turns 67. Now, before we can start analyzing if it's worth rolling over or how much you can save if you roll over, I want to talk about how you find the fees that you're paying. One way you can do it is you can type in ticker symbols into Morningstar or Yahoo Finance one by one. That can be time consuming though. You can ask your HR department about your 401k plan, about the fees you're paying. Well, that can be frustrating and you might be waiting a long time. In fact, you might not get a response at all. I use WealthTrace to find the fees. WealthTrace actually lists all the fees for all of your funds, both in expense ratio terms and the dollar amounts you're paying every year. I also like to compare the fund performances in WealthTrace, the historical performance. So if I'm looking to maybe switch from a fund in a 401k to an IRA, I'll just line them up side by side and compare them over the last few years, the 10-year return, year-to-date return, and it also takes into account the expense ratio of each fund. All right, so here's how I did it. In this plan in WealthTrace, I inputted an expense ratio, an average expense ratio for the 401k plan of 0.7%. Reasonable. And this person would have a net worth at the end of their life expectancy of about $1.9 million. Now, before we get into how much this person saves if they move to an IRA, I do want to talk about compound interest a little more. As the great Albert Einstein said, compound interest is the eighth wonder of the world. He who understands and earns it, he who doesn't pays it. Now, the people that will pay it are the people who stay in high fee funds. The people who earn it are those who lower their funds and can get this little exponential hockey stick you see here for the compound interest. That's what you want. You want earnings on earnings that go over time, and you get this nice hockey stick for your investment balances. Here's another way to look at it. So I created this chart. I ran this in WealthTrace. $100,000 invested at 8% versus 7%, right? Let's just call that a 1% fee. In 15 years, the difference in this investment is, a little under $50,000. So you would save a little under $50,000 if you had a higher return here, 1% higher. But over 30 years, it's almost $250,000. So it's not double, it's more than 5 times the savings. So that's the exponential part of the compound interest I'm talking about. Now let's get back to our client case at hand. What I did was I changed the expense ratio from 0.7 to 0.1. So just a 0.6% difference. But over many years, 30 years in this case, his net worth goes up by over $500,000. Okay, not $5,000, $500,000. That's over 30 years, but that's compounding at work. In the world of finance, little differences in returns and fees compounded over many years can grow to a giant amount. Here's another way I like to look at this. How much more could this person spend in retirement per year if he just moved to the lower fee funds? So I punched this into WealthTrace as well, and I calculated that to get the same net worth as before, he could spend $12,000 more a year. Whether it's on vacations, cars, spending money on his grandkids, whatever, $12,000 more a year for 30 years. and he'd have the same net worth, but he has to move to the lower fee funds to do this. So to summarize what I've gone through today, I really do want to hammer home that it's not difficult to roll over 401k to an IRA. Don't picture some bureaucratic mess like you have to go to the DMV or something. It's easy. The providers have made this easy. In my little case study, I showed that it is possible you can save thousands of dollars over time. A lot of money at stake here. And IRAs generally, versus a 401k, have lower fees, better fund choices, and no conflicts of interest. So I'm ready for questions. Let's take a look here.
As a reminder, you can ask any questions here in the chats. Doug, looks like there's one question. If I have an expense ratio of 0.6% and in my 401k it's a fund of funds, am I paying triple funds now? The retirement fund, that 401k provider, the fund of funds fee, and the individual fees for those funds.
I'd have to see it, but I would really guess that that's for the whole thing. 0.6 it's not triple. It's probably just 0.6. But I don't know that for sure. You might want to double check that one.
If we're thinking about like a target date fund, for example, that has a bunch of like sub ETFs, I'll imagine the 0.6 is it's like adding up the expenses of the individual funds that comprise the target date fund, but probably doesn't include the overall 401k fee, right?
Well, yeah. So that, yes, it would be basically one fee for a target date fund. You don't have to worry about the ones that are inside of it. So they would definitely give you the one fee. 401k fees that's different. There are administrative fees potentially for a 401k as well, which you'd have to ask your HR or plan administrator if there are any admin fees on it. We have several more questions that popped up. Can you do a direct rollover to more than one IRA? I have an IRA that is managed. Can you do direct rollover to more than one IRA? I believe you can if you wanted to split that up into more than one. That's the kind of thing you definitely have to make sure you get straight with the 401k provider and just give them the right account numbers and the amounts. Here's a question. Can I add funds to WealthTrace that I don't own to be able to track fees and performance? Yes, but it would be inside your retirement plan, so you'd want to probably give it a zero balance at that point, right? So it's not in the calculations. But yeah, you can track all kinds of different funds in WealthTrace. What about load versus no load? Does WealthTrace include this in its calculations? No, we don't have access to the load information. These loads are pretty bad, kind of a relic at this point. You don't see them as often, but there are definitely some funds that are out there that still have them. So watch out for that. That's a really good question. I should have mentioned that's an extra fee basically when you get into a fund and or get out of the fund, you can be charged. So bear that in mind when looking at fees. Oh, someone's asking what costs to use WealthTrace. Well, we do have a discount, which I'll mention here in a bit. 25% off. You can see the discount code here. Well, I'll just mention now, PortfolioPilot as well, 1 month free. You can see that you can get 1 month free with their discount code here. We have a standard version that's $229 a year for WealthTrace, and the deluxe version is $289 a year. Can I do a partial rollover to an IRA? Yes, normally you can do a partial rollover, not all of it. Yep. And then another one, let's see here. I left my 401k in Fidelity. Can I roll over now? Yeah, you can roll over whenever you want. Can I roll to a Roth or do conversions? No, you have to roll to traditional. But well, then you could roll it over, or sorry, you could convert it once. You can roll it over to an IRA and then convert it to a Roth after that. Another one, I retire soon, July. 725. Tend to do direct rollover. Is there a period I should wait? Oh, well, no, I'm not sure. Is there a period I should wait, or can I make it right away? I'm not sure. Ask the provider. That's. I would guess you can do it right away, but you never know some of the rules of these providers. Oh, here's a good question. Can I roll my 403B into an IRA to keep the investment that's closed to new buyers? So this would be called an in-kind transfer of the investment. So you can move your investments. That's what I did when I rolled over. I actually moved the investments initially and then sold most of them inside the IRA. But you can do this, but it's closed to new buyers, so they might put up a fuss. Again, every provider is different, but generally speaking, you can move the actual investments right to your IRA.
So is there any difference here between everything you've mentioned today for 401ks and 403bs? Is the same logic applies?
Should be the same logic, yeah, exactly. Yep. And a Roth 401k, same idea. You should be able to roll that. But all those, it's different, obviously, but you should be able to roll that over as well. Prior to retirement, can I roll over prior to retirement? No. You have to go back to that slide that I was showing before about when you can do it. You have to retire, leave your job, or they have to terminate the plan.
What about required minimum distributions? Is that affected at all throughout this process?
No, the rules for required minimum distributions are exactly the same for a 401k versus an IRA. It's the exact same calculation. Oh, here's a question I thought I had in the presentation. That's funny. I don't know where it went, but I'm glad you asked. Can I borrow from a 401k Roth like a 403b? Well, what I really was going to say is you can't borrow from an IRA like you can from the 401k. The 401k Roth, that one I'm not 100% sure about. You might want to ask the provider. So my hunch is you can. But an IRA, the answer is no, you can't. Does WealthTrace suggest new index fund to replace the high fee investments? Well, no suggestions, but you can punch in a variety of funds, like I said, and compare performance and fees. That's the way our users do it. So it's not. I think maybe that's more for PortfolioPilot. Could correct me if I'm wrong, Alexander, but in terms of suggesting.
Yeah, with PortfolioPilot, we'll actually recommend specific replacements, and that's probably the difference in the fact that we're a financial advisor, right? So we're not doing a lot of the long-term scenario modeling, but specific fee replacements and investment advice. We got that covered. Maybe, Doug, it's a great time to wrap. Mention the promo codes. Say goodbye.
Yep. Thanks, everybody. Take care.